Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Go Fashion India Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Gautam Saraogi, CEO. Thank you, and over to you, sir.
Good morning and warm welcome to everyone present on the call. Along with me, I have R. Mohan, our Chief Financial Officer, and SGA, our Investor Relations Advisor. Hope you all have received our investor deck by now. For those who have not, you can view them on the stock exchange and the company website. We have started FY23 with a very strong performance in the first quarter. Our revenue stood at rupees 165 crores, highest ever quarterly revenues at Go Fashion. EBITDA and PAT stood at 53 crores and 24 crores respectively. Our volumes also have grown exponentially. This has been on the back of improved product portfolio by continuously adding new products across all bottom wear categories. Our revenues compared to FY20, that is pre-COVID levels, have increased by 72%, and SSG for EBOs stands at 30% for Q1 FY23 compared to pre-COVID levels, that is Q1 FY20. Our product is being core and essentials to customer has enabled us to operate on a business model where we offer limited discount and sale of our product is typically at full price, which in our experience results in greater profitability. 90% of our sales for Q1 FY23 are on full sales. In addition, our EBO's average selling price has increased primarily on account of value-added products that we have introduced as part of our portfolio. Our ASP for Q1 FY22 stands at rupees 716, a 9% increase from our last quarter. As mentioned on our last call also, the company is looking to invest in brand building initiatives which will help us gain visibility and also to focus and grow our online sales to benefit from the evolving customer trends in our market. During the last quarter, we launched 3 new films on a pan-India platform for 6 weeks. Each of our films showcases the individual triumphs and journeys of women. The link of all advertisements has been added in the press release and presentation for your reference. During Q1 FY23, the company has added 30 EBO stores, and our EBO store count as on 30th June 2022 stands at 533 stores. As guided earlier, we will add 120 to 130 stores in FY23, which is in line with our growth expansion plans. We are also looking at omni-channel engagement for a seamless consumer experience, building on a technology-driven growth strategy to reach consumers across all cities. We are leveraging technology to bring cost efficiency and enhance customer experience. We intend to further improve our operating efficiency and ensure efficient supply chain management through global best practices. We will look to upgrade our warehouse to optimize our inventory and supply chain. Also during the last quarter, the company has taken a new warehousing facility in Bhiwandi in Maharashtra of around 12,177 square feet. This will help to cater faster and better to the western regions of the country. Coming to working capital front, we have reduced our working capital days to 133 days compared to 190 days in 31st March 2022. We are further working on reducing it. We look forward to continuing our innovative and creative approach and launch more designs while providing more brand destinations for our consumers, which will help us grow and gain market share in the coming years. Our focus will be to target customer acquisition to drive sales through our website and online marketplaces. In addition, we intend to invest in content generation to build engagement with the younger audience. With this, I would like to hand over the call to our CFO R. Mohan for the update on the Q1 FY23 financials. Thank you.
Thank you, Gautam, and good morning, everyone. The company has posted a strong performance for the quarter ended 30 June 2022, backed by an increased demand across product categories. Our revenues for the quarter stood at 165 crores as against 31 crores in Q1 FY22. Gross profit stood at 100 crores with a GP margins of 60.6% for the quarter. Our EBITDA for the quarter stood at 53 crores as compared to minus 6 crores in Q1 FY22. Our EBITDA margins, which stood at 32.1%. Profit before tax for the quarter stood at 32 crores, whereas profit after tax for the quarter is at 24 crores. A 73% YY growth vis-a-vis Q4 FY21. Cash and cash equivalent as of June 28 stood at rupees 130 crores. With this, we will now open the floor for the Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. A reminder to participants, please press star and 1 if you wish to ask a question. Our first question is on the line of Ankit Kedia from Phillip Capital. Please go ahead.
So congratulations on good numbers. Just wanted to understand this SSG of 30% over pre-COVID in more detail. Could you share what will be the volume growth and value growth in this SSG?
Yeah, sure. Thanks, Ankit. So, Ankit, see, this 30% what we have compared with is obviously the pre-COVID levels because last year, same time, due to COVID, the numbers are not comparable. So, when I compare with Q1 FY20, which is April, May, June 2019, our value SSG is at 30% and our volume SSG is around 16-17%.
So that, okay, so around 14% price increase and 16% volume increase.
No. 30% is the SSG, is the value SSG, and 16-17% is the volume SSG for stores which were live between Q1 FY20 and Q1 FY22.
So the reason why I'm asking, because the price increase itself is 30% over pre-COVID. If I take your FY19 full year ASP and compare it to the current ASP. So in that light, when you're saying 30% is the value SSG, the numbers don't match up.
We'll have to, so Ankit, we'll have to check on that and come back to you. But it is, from what we have checked, it is more or less in line because the price hikes also were taken at different stages, Ankit. Usually, when we take a price hike, the inventory which is there existing in the channel, that over a period of time, the price transformation happens. We don't change the pricing of the pieces which are there at the store level. So the price increase happens over a period of time and not immediately once we've introduced the new price. So it's little difficult to connect the dots between the two.
Sure. So the reason I'm saying is because FY19 full year ASP was around 559 rupees and today your ASP is around 718 rupees. So that makes it a 27% ASP increase over FY19 full year. So Q1 FY20, I'm assuming the ASP would be the similar 560 rupees, and on that 28% is the price increase itself.
We'll have to check on that and come back to you, Aniket. Probably through SG we'll come back to the clarification on that.
Sure. So my second question is, regarding the current demand environment. Could you explain where is this growth of, volume growth coming in the quarter over, quarter 4 itself? Is there a seasonality angle in quarter 1, or it's, pent-up demand, or inherently new product launches, or your new advertising campaign is leading to this demand?
So Ankit, see, our business is more on a YOY basis than a quarter-on-quarter business. So in our business, usually the best quarter of the year is quarter 3, followed by quarter 1, then quarter 2, and then comes quarter 4. So if you actually see, quarter 4 is the weakest performing quarter of the year, and quarter 1 is the second best performing quarter of the year. So, and the reason why we have the seasonality in sales is because of different reasons. Now, Q1 in particular does well because the entire industry goes on EOSS. And during EOSS, the sales and the footfalls in high streets and the malls are a lot more than quarter 4. So, the reason the sales have increased dramatically and the volumes have increased compared to the preceding quarter is because of increased footfalls at malls and high streets.
Sorry to interrupt here. The volume growth vis-a-vis that the Q1 FY23 vis-a-vis Q1 FY20 is 4% and the value growth is 30%. Gautam?
Oh, is it so? Okay, my bad.
Yeah, it's 4%. What KDA Ankit is saying is reasonably correct because it is 4% and 30%. Just wanted to add.
Sure. I stand corrected, Ankit. I probably made a mistake on the number. The volume is 4%. What Mohan is telling us.
Thank you. That's it. And so last question is on the working capital. We have seen significant reduction in working capital in the quarter. What has gone from quarter 4 to quarter 1 in reduction in inventory and payable days? If you can highlight, it will be appreciated.
Yeah, so I think, look, what has really brought down the working capital days from 190 to 130 is just based on pure sales. I mean, look, there is no reduction in inventory or debtors as such. In fact, the absolute number from March has actually gone up as far as inventory and debtors are concerned. It's just that because the top line revenue has actually improved, we have seen a reduction in working capital.
Okay. That's helpful, sir. Thank you so much. I'll come back in the queue.
Sure. Thanks, Ankit.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. The next question is on the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Yes, sir. Hi. Thanks for taking my question and congrats on strong execution on both growth as well as working capital front. So you indicated out of this 30% SSG versus Q1 FY20, 4% is volume and I guess rest 25% is realization there. And within this 25%, I just wanted to check what has been the price hike that we have taken and what has been contributed by the mix improvement for value-added products.
Yeah, sure. Thanks for the question, Devanshu. So Devanshu, this ASP increase would be largely because of the price hikes. Because we have taken 2 price hikes and there have been a considerable amount of price hikes. So this ASP would be largely, it's difficult to quantify how much was contributed by price hike, but it would be largely price hike.
Okay. And given the way cotton prices are behaving, so how should we bake in going ahead? How is the RM situation currently for you guys, and do we will we require another round of price hikes?
Yeah, see, from an RM perspective, right now we are seeing it's pretty steady. The last 3-4 months, what we have noticed, it has been pretty steady. We'll have to wait and watch. As of now, what price hike we have taken has covered the raw material increase price, what has happened over the last 18 months. But as of now, the price fluctuations are steady as far as the RM is concerned, from what we are seeing in the last 3-4 months.
Sounds good. Secondly, I wanted to check, we have been giving this commentary as in we expect the share of LFS to sort of reduce and share of other channels to increase. However, if we look at the store edition front in this channel, it has been quite impressive. So is there any change in outlook for this channel or we maintain our earlier commentary here?
We maintain our earlier stand, Devanshu. Just that, look, this quarter we grow our LFS business very selectively, frankly. So we have seen some very good opportunities in our current LFS partners, and we have grown that many stores. We have actually added a lot more stores this particular quarter, and that's why the skew is showing more towards LFS this quarter. But otherwise, our stand is very clear. EBO will continue to grow at a faster speed than LFS, and in the coming quarters, you will see the shift happening more towards EBO sales, for sure. But growth in LFS will continue, but in a very selective basis.
Sure. And for working capital, sir, just wanted to check as in how it has been calculated. In the denominator, we have annualized Q1 sales, or we have taken trailing 12-month sales for calculation of working capital.
Q1 sales.
Okay. And lastly, I wanted to check on these ad expenses were sort of typically higher at about 4.5% versus 2.5% historically. And is this a quarterly thing where Q1 saw higher ad expenses, or structurally also we expect higher ad expenses going ahead?
See, this year we have budgeted the ad expenses to be a little higher because we've seen that consumer retail has come back very strongly, and this year we want to, and because we have the scale right now, we feel that spending on little advertisement will help us build the brand on a long-term basis. So what we have seen about 4.5% in Q1 will be also on an annualized basis as well. So this year, 12 months, we are expecting our ad expenses to be between 4 and 5%. Which is a little higher than our general ad spend.
Yes, it's about 200 basis points higher.
Exactly.
Sure, so I'll come back in the...
On an annualized basis, about between 4 and 5% will be our annualized ad spend.
That's helpful, sir. I'll come back in the queue for follow-up questions.
Thank you. Thank you, Devanshu.
Thank you. The next question is from the line of Akshay Thakkar from Fidelity. Please go ahead.
Yeah, hi. Congratulations on a very strong set of numbers. I had two questions. One was around how should we be thinking about gross margin? You've seen some sequential decline this quarter. I don't know if it's to do with mix or seasonality, but just generally, given where raw material prices are, the pricing action in pipeline, how should we think about gross margin? That's question one. And question two is just building from your last comment that A&P would be higher, which is obviously a great initiative to build a brand over here. But how do we think about guardrails of EBITDA margin? Maybe this year or into the medium term. Those two questions have follow-up, but I'll wait for you to answer this and then come with that content.
Sure. So actually, see, from a GM perspective, we see from a raw material perspective, we estimate that we don't see any further increase in raw material pricing. And for what was increased, we have already taken the price hike. So we see consistency in gross margin. This quarter, like very rightly you pointed out, our GM, there has a slight decrease, and that is because of channel mix. Because LFS being slightly stronger this quarter, that has reflected in the gross margin. Otherwise, as quarter on quarter our EBO sales share increases, the GM will take an upside correspondingly. Now, coming to ad spends. Ad spends was your second question, Akshay?
It was around EBITDA margins in the context that...
EBITDA margins and then ad margin, yeah. So see, look, this year we are, our usual, the EBITDA margins what we reported in quarter 3 was around 36%. This quarter we have reported about 32%. The decline of the 3 to 4% 3 to 4 EBITDA margins is because of the ad spend. So this year we see the EBITDA margins to be around the 31-32% range. Next year ad spends, it's hard to comment right now. So for me to tell what is going to happen the next financial year will be a little tough. But this year it will be in the range of about 31 to 32% as far as the EBITDA margins are concerned. Because our ad spends are slightly higher than last year.
31-32%, right?
In that range.
Okay. All right. Great. Second, maybe could you just take a step back and talk through, beyond seasonality, how is the consumer demand shaping up? Because you've seen inflation both in your product category, in apparels in general inflation is high. Are you seeing at the margin any slowdown in footfalls, etc., or any changes in behavior? This is macro, not so much particular to this company. Just would love to get your comments around that. Thank you.
See, we've seen that consumer demand has picked up very well compared to Q4 and Q3. I think gradually the consumer demand to like how it was pre-COVID has come back very strongly, and that's why we've been very happy to report that we've had a 4% volume growth over Q1 FY20. So the consumer demand, the consumer footfall, the sentiment has definitely improved a lot in the last 6-7 months. And with cinemas opening up, I think a lot of customers have come back to malls. So I think that's made a very positive impact on retail in general.
Okay, thank you.
The The next question is in the line of Ankit Gupta from SBI Mutual Fund. Please go ahead.
Hi, sir.
It seems we have lost the line for Ankit. We will move to our next question from the line of Hardik Doshi from White Whale Partners. Please go ahead.
Yeah. I just want to ask about the volume growth, which I think is mentioned was 4% over a 3-year period, which works out to about a little bit over 1% on an annualized basis. So isn't that a little low, or how do you see same-store sales volume growth over the next, let's say, 2-3 years?
I think, Hardik, look, whereas our volume growth at a same-store sales growth level has been a little slow, but at the overall company level, we have grown from, if I take Q1 FY20, we've had a 41% volume growth compared to Q1 FY20 at the overall company level. So I think, look, the way after COVID, I think considering how the market is slowly coming back to normalcy, we feel 4% is a very, very good number for stores which were present 3 years back.
Okay. If I had to ask another way, before COVID, what was, in the few years before COVID, what was a normalized kind of same-store sales growth that you used to see?
We, on a normalized basis, pre-COVID, we were seeing volume growth of about 9 to 10%.
On same-store sales basis?
Exactly. Yeah, correct.
Okay. So basically, this would imply that at least compared to pre-COVID to now, the consumer spending is not really fully come back, or there's still more room for it to kind of...
There's still more room for improvement, but it's definitely improved a lot in the last 6 months compared to what it was probably in Q3. I think the improvement is considerable.
Got it. And in terms of inventory days now, have we pretty much reached an optimum level, or is there still room to go?
No, there's still room. See, right now we are at about 100 days, Hardik. We would ideally want to be at 90 days.
Okay. And overall, and apart from that, in terms of payables and receivables, those at optimal level?
On an adjustment basis, on a inventory plus receivable minus payable basis, I think we would ideally want to be at around 120 days. See, currently we are at about 133 days. So we would ideally want to be at 120 days, where payables would continue to be at 9 to 10 days, because we reduce our payable days as much as possible so that we get better prices, and that gives us a positive impact on our gross margin. So we would want to keep payables days low. So our overall working capital days, we would like to keep it at around 120 days ideally, which is at 133 days today.
Okay, got it. And just lastly, in terms of the 30 new EBOs that we opened, what would be the mix between metro and then maybe tier 1, tier 2? Just wanted to see the mix shift.
Actually, surprisingly, this time, we've added a lot of stores in the top 8 cities. Look, we are still seeing a lot of potential in our top 8 cities markets, which are very strong. And in fact, out of the 30 stores, majority of them would be from the top 8.
Okay. So I guess in terms of overall mix, the share of the top 8 is still kind of being maintained, or
maintained. No, in fact, I think, look, it will get stronger because we are seeing great opportunity everywhere of adding stores in fact, in Mumbai city, where we already have 50 plus stores, we are still seeing to add another 20-30 stores in the short term. So look, the opportunity in the top 8 is very big.
Mm-hmm. And why is that? With so many stores in Mumbai, I guess you're still not covering the entire geography.
No, I think what is happening is the top 8 cities also are growing continuously every year in terms of size and the number of people also moving to larger cities. That's the assumption I'm making. So we're still seeing a lot of potential there from that perspective.
Okay, got it. Okay, thank you very much.
No problem. Thank you.
Thank you. The next question is from the line of Manish Poddar from Motilal Oswal AMC. Please go ahead.
Yeah, hi, Gautam. Thanks for doing the call. So, did you mention that you expect EBITDA margins to be in the 31 to 32% band for the full year?
Yes, absolutely. That's on account of higher ad spends of about between 4 and 5%. Correct.
No, so, can you help me explain? Because if you look at the ad spends for the full year, last year were about 1.26%, and this year you're seeing, let's say, 4 to 5%. So there's a roughly, 3.25% delta. in terms of increase in cost. So, and you're still expecting, margins to improve on a YOY basis. So, last year, full year EBITDA margin was roughly 29.7%. So there's a 450 to 500 bits delta on an annual basis. What is really driving that?
No, see, last year we had an EBITDA margin of 29%, but because the first half of the year, Manish, was impacted because of COVID. So the full year's EBITDA margin of 29% does not really reflect the true EBITDA picture. On a quarterly basis, look, Q3 was our strongest quarter where we had about 36%. So because we've actually increased our ad spend by 2.5-3%, that's how I've arrived at that 31 to conservatively I've arrived at the 31 to 32% estimate.
But and in terms of rollout for in terms of doors which will roll out for LFS, how many doors do you plan to roll out this year?
See, we actually had our plan of about 100 to 150 doors, and we have added a good number of them in the first quarter because we got the right opportunities where we wanted. But on an annualized basis, about anywhere between 120 to 150 doors.
So incrementally, there won't be any addition from this channel. Is that how one should look at it? Because you already added 125 in the first quarter.
Ideally, that would be our estimate. But if in case we do get some good opportunities, we might also increase that number. See, it depends. Because LFS is a very good, Manish, LFS is a very good channel for us where we are able to create a presence in newer towns where we want to expand in the future years to come. So sometimes when we get those very good opportunities, we would ideally take them.
Okay. And would you be able to help me with the cash flow from operations for this quarter?
Yeah, so cash flow from operations has been, so we've generated about close to about 40 crores in cash. And we've had increase in working capital by about 48 crores. So we are negative, cash flow from operations is negative at about -8 crores.
And the entire capex for this quarter was roughly about 10 crores. Is that the number?
I think it's around 6-7 crores, if I'm not wrong.
6 crores. The warehouse thing of 2 crores, right?
Sorry?
The warehouse, beyond the warehouse, would that be 2 to 3 crores?
No, it would be much lower. I mean, the capex there, so that's a very small micro fulfillment center. The capex there wouldn't be too much. It wouldn't be very material in nature.
Okay, fair enough. Thank you.
Thank you, Manish.
Thank you. The next question is from the line of Aniket Sethi from ICICI Securities. Please go ahead.
Hi, Gautam. Hi, Mohan sir. Thanks for the opportunity. Gautam, a few questions on the LFS part, a few follow-ups. So first is, what would be your store penetration with your existing partners? So just to kind of understand the headroom. Second, have you kind of, let's say, recruited a new partner, or was it more from the existing retail partners? The third bit is, if you could also highlight, is this more of a pull from the retail partner side, or you have your discretion, based on the location of every specific LFS store?
Yeah, so thanks, Aniket, for your question. So look, we have 100% discretion, and we basically select. We don't select everything what comes our way in terms of LFS. We have the right to strategically select what we feel is more relevant to us, frankly, from a zone perspective and strategy perspective. So that is never a problem. But this major growth of LFS stores, what has come by, has come from our existing partners. So we've not really added new partner. We had added.
Ladies and gentlemen, it seems we have lost the line for Gautam sir. We request all participants to please remain connected while we reconnect them. Gautam sir, you're connected and unmuted.
Yeah, sorry, the line got cut. So Aniket, I was saying, can you hear me? Am I audible?
Yes, you're audible.
Yes.
Yeah. So Aniket, see, let me start from the beginning. So we have full discretion of what stores we want to select with our LFS partners. It's not that we select everything what comes by our way. We strategically select based on the zone and the kind of city we are getting, and then we decide whether we want to do that particular new addition or not. So that is never a concern from addition perspective. Now, as far as the new stores, what we've increased in the quarter, this has largely come from our existing partners. So one of our major bigger existing partners is Reliance, and we've added a good number of doors in Reliance. Now, the new partner what we had added last quarter or the quarter before that was Pantaloons, but our presence in Pantaloons is still very small. We are there in about only 15 to 16 doors. So the major expansion what has happened has come by in Reliance.
Understood. And what would be our penetration with Reliance currently in terms of number of stores?
We haven't checked their overall database of stores recently, but we would be in most of them.
Understood. And thanks for that. That's really helpful. Second, on the ad spends, can you share some initial results? You have increased your ad spends after let's say a couple of years. I mean, most of the brands were kind of invested for last 2 years. What are the kind of spends you are doing here? How are you measuring the effectiveness? And you have also stated that the current campaign was running till end of July. So what are the other kind of things you are planning over here?
See, so Aniket, right now, so I'll tell you the kind of ad spends we are doing. There are two types of advertising. Right? There's a bottom of the funnel performance advertising, and there is top of the funnel brand building advertising. So what we are currently doing is top of the funnel brand building advertising, and this brand building advertising are results which we will see over the period of years and quarters. It is not a result which you will get immediately. So the advertising what we have done right now is very hard to say whether that has created upside in our June and July sales. That's because this is more from a brand building perspective. And we wanted to maintain a good ratio of ad spends to revenue, and we thought that 4 to 4.5% from a percentage perspective and also as an absolute amount is a good amount to do brand building. Now, this quarter, we had run a 6-week campaign which will run till July, which has ended July end. Our second campaign should ideally start during festive.
Understood. And a lot of this is digital spend, right? On YouTube and social media.
No, this has been largely television.
Okay, fine, got it. Lastly, just want to check on the store addition bit. So in terms of the site pipeline and availability, you're confident of the 120, 130 guidance, right?
Yes, absolutely.
Perfect. Thank you so much. Thanks, Gautam. Wish you all the best.
Thank you, Aniket. Thank you.
Thank you. The next question is on the line of Himanshu Nair from Systematics. Please go ahead.
Yeah, hi team, and congrats on a good quarter. So firstly, if you can just give us some color on your e-com and omni-channel capabilities, because I know that's a small proportion of our sales, but just wanted to understand what all are you doing to scale that up, and is there a number in mind where you think this is a number you would want to achieve? And in terms of current capabilities, how many stores, would you have supporting omni-channel, if at all?
See, right now, Mansu, what we have done is the first target was to take our website live, our new website, and we have taken our new website live, and the website is doing, from a performance perspective and efficiency perspective, the website is doing well. If I take my absolute number of online sales, our online sales have actually, on an absolute basis, has increased over Q3 and Q4, which is a very good sign. Though our online base is very small right now, we are trying to scale it as much as possible. Right now, currently it's 2.5%. So our first target is that if we can take the 2.5% to about 5%. As far as omni-channel through stores are concerned, see, currently our first target was to get the site up, which is up and running. Now we are integrating it slowly with our stores. So over the next probably 2 to 3 months, we should see store deliveries and store dispatches starting for online sales in the next 2 to 3 months. That integration and that is under process right
now. Okay, understood. And the second bit was on the competitive intensity. So just wanted to understand whether you've seen any significant increase in the last few quarters as demand has sort of come back, maybe from other brands or even the private labels of larger retailers. So any color there would be helpful.
Yeah, so Himanshu, we have seen a national player entering the space, and we are seeing many regional players also doing this as a strategy. But I think as far as demand is concerned for our product and our brand, we've not seen any slowdown because of competition. And we understand that competition is there, and we are also, increasing our footprint so that we have a competitive edge.
Mm-hmm. But is there typically, any conflict that you see with these LFS partners? I believe at least a few of them would have their own private labels in the same space as well. So any conflict in terms of getting shelf space in a few of those large format stores?
So LFS private labels are not competition to us, Himanshu. See, because LFS private labels are actually not really very big competition to any of the external brands, frankly, because the kind of range they carry in bottom wear is much lower in terms of number of colors and number of compared to what we have. So I would not take LFS private labels as competition. In fact, for example, we have been in LFS for a very long time, and we have been coexisting with their private label for a very long time, and even they do very well, and even we sell very well. So there's no real competition between us and private label. We are not competition to them, and they are also not competition to us. Let me put it that
way. Got it. All right. So that's it from me, and thanks and all the best.
Thank you, Himanshu.
Thank you. Our next question is from the line of Rajiv from TAM Capital. Please go ahead.
Hello. Good morning, sir. Thanks for the opportunity. So my question is on your cash. So we have generated 130 crore, the cash on cash equivalent 130 crores versus 106 crores. Can you give a breakup of where is it coming from? And if you can specify the inventory, absolute inventory number for this quarter.
See, our absolute inventory would be about 185 crores. The cash what we generated in the quarter was around 40 crores of cash we generated in the quarter, and we had increase in our working capital by about 48 crores. So our cash flow from operations has actually been minus 8 crores. So in fact, our cash balance from March to June actually has come down in absolute terms.
What you report? What you reported in Q4 was 106, if I'm not wrong.
Yeah, but that would probably not include our mutual fund and liquid fund. See, this 130 crores what we reported this quarter is cash in hand, fixed deposits, and your liquid and mutual funds.
You're saying in 106 you didn't have that mutual fund thing?
Yeah, we didn't have them.
No, that is shown as a separate line item as an investment because it is a statutory year-end finalization.
Okay. So what was that? Okay, sure, got it. And in terms of this the positioning bit, because we have taken close to 170 rupees price hike from Q1 20 to till today. Have we found competitors which are filling in this space? And are you happy with the 4% volume number? I mean, is this what we should build in for the old stores?
Yeah, 4% is a very good number. In fact, I think it's a good number considering that market is coming back and older stores are growing at on an average of 4%. I think it's a very good number to begin with. Of course, our endeavor will be to strengthen this 4%, which goes without a doubt. But as management, we are very happy with the 4%. Now, what was your second question?
No, because this 550 to 718, the price band which you have increased in the last
so that 550 to 718 would not be fully on the basis of price hike. See, we have taken a price hike of about $100 in the last 2.5 3 years, about 100 rupees between FY20 and FY22. Now June, so it's about 100 rupees. So the balance would be because of the product mix.
And what would be the leggings portion as of today?
Even today, leggings continues to be strong. Leggings and churidars contribute to about half of the business, even today.
All right, fine. And in terms of let's say the prices were to come down, historically, is there a trend that you will maintain the gross margin and bring down the the prices proportionately?
No. See, even even if the RM price goes down, we will not bring down our selling price, because if we even think about doing that, it will create a very negative impact in front of our end customers. They would not understand why we are bringing down the price. So we would never bring down the price, even if there is a decrease in RM.
Sure. And you said there is minimal capex on this warehouse.
Nothing material, because it's a small micro fulfillment center which was opened, and it's not a material investment.
Right. That's all from my side. Thanks a lot. All the best.
Thank you. The next question is from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
Hi Gautam, thank you for the opportunity. What will be the mix of value added, and how do you define it in your business?
See, basically, I mean, look, our entire product category are essentials and core. But if I have to bifurcate in that, leggings and chudidars, which are our oldest core products, that contributes to about half of the business. The balance half comes from products like trousers, pants, jeggings, harems, patialas, palazzos, and the other bottoms, basically. So anything which is not leggings and chudidars, we bucket it as other bottoms or value-added bottoms.
Okay. And what will be the price differential between the core product and these newer value-added products?
It will not be too different. See, our leggings and chudidars are at about $599, and the other value-added products would be about $750, between $750 and $900. It will be around in that average.
Okay, got it. And
see, for us, what we have done, Dilip, 80% of our product portfolio, we are pricing it less than 1,000.
Okay.
So we don't want a situation where we are coming out with newer products priced very high. We don't want to do that.
Got it. And on the margins, you mentioned that 31-32% is possible this year. If you could, give some sense on channel-wise margin and also your online and LFS margins specifically, because those are the lower margin businesses, right?
So see, EBO margins are the best, which goes without doubt. EBO margins gives us about, at a channel level, before corporate and advertising overheads, at a channel level, EBO gives us about 33% of EBITDA at a channel level, whereas an LFS would give about 25% and online would give about 20%. So because our mix is heading more towards EBO, which is of a higher profitability, that will improve our EBITDA margins any which way, which I have not factored in when I've given the estimate of 31-32.
Right. Okay. And lastly, Gautam, on your volume growth, which has come down from 9% pre-COVID to around 4% today, despite adding new stores in the last 2 years, this number looks a bit lower. So is there some challenge on the new store additions?
This is SSG, 4%. Our overall volume growth from Q1 FY20 till now has been 41%.
Okay. So just wanted to understand.
These are the same stores. These are the same stores which were operational in Q1 FY20 and are operational today. Those stores have grown at a volume level of 4%. The overall business has grown at a volume level of 41%.
Okay. Right. Got it. And, just wanted to understand from you on the new stores which you are adding, how many months is it taking you to ramp up on these stores to get to where your mature stores are? And if you can, highlight a bit as to what the difference is between a tier 2 customer and a tier 1 customer, if there are any challenges on downgrading due to the higher prices that are today. Thank you.
So Dilip, see, we from a mature store perspective, when we open a store, usually our store tends to mature between a year and a half or 2 years. It takes to reach some sort of maturity. So when we open a store, say this quarter, probably by middle of next year or end of next year, we should probably see some sort of maturity in these stores. Now, as far as tier 1 and tier 2 are concerned, see, for us, because our product is core and essential, the customer buying behavior between a tier 2, tier 3 versus a tier 1 is not very different. Okay, maybe leggings as a category might sell a little more in tier 3 and pants as a category might sell a little more in tier 1. But otherwise, more or and some colors may sell better in tier 2, tier 3 and some colors might sell better in tier 1. Apart from these small minor changes, I think overall the consumer behavior has been very similar for us in tier 3 versus tier
1. Right. Okay, got it. And lastly, Gautam, so from here on, we should bake in about 4 to 5% of SSG on your older stores, and the newer stores will just add to the volume growth, right?
Absolutely. Absolutely. So in the current stores also, we target at least 4 to 5% of volume growth moving forward on a steady state basis. Yeah, on the current store.
And in your opinion, are there any levers, maybe to add another category, to beef up this 4 to 5% which you're doing on the existing stores today?
See, currently we see a lot of scope in bottom wear. So, I mean, look, we will continue to add new categories of ladies bottom wear, but we are not currently as a strategy looking outside ladies bottom wear for now, because the scope here and the depth we can go in is very long.
Right. Okay. Go ahead, Gautam. Thanks a lot. Thank you.
Thank you. Thank you.
Thank you. The next question is on the line of Akhil Parekh from Centrum Broking. Please go ahead.
Hello.
Yeah. Hi, Akhil.
Hi, Gautam. Thanks for the opportunity. Just continuing on the last question. What are the steps we are taking basically to increase the throughput or the increase the volumes from our older stores? Because one of the challenge I feel is the store size for Go Fashion is limited, right? So to increase the SKUs, that's going to be a challenge, mainly because the shelf space is limited. And second is you can't increase the footfalls beyond a point because the store size is at 300 to 500 square feet. So which leaves with only other option, that is to increase the sales from the older store through the increase in ASP basically by either doing the product mix or the price hike. Would that be a fair assessment?
See, for us to sustain the volume growth, of course, is a good question. And look, I think at the end of the day, the company has to build a lot of brand equity and brand value. So that's why, look, we started brand building initiatives. Also, as our store expansion happens, I feel our newer stores will also drive volume in our older stores. See, because the more the customer sees a brand in terms of visibility, that much the brand builds in the minds of the customer. So with the expansion plans, what we have about 120 to 130 stores, and we are continuously adding newer categories of bottom wear, I think our older stores should be able to deliver 4 to 5% of volume growth on a steady state basis. Now coming to store size, which you rightly mentioned. See, for us, we don't see our store sizes dramatically going up, and I'll tell you why. We are continuously fine-tuning our inventory. So we are our artificial intelligence at the back end, on the basis of which product is selling and how it is selling, it keeps optimizing the inventory what we have. So for example, if a product is selling slightly less than the new product is being added, I will reduce the number of quantities in that particular SKU and bring in the new product category. So for me, because I'm optimizing inventory on an ongoing basis in the store, for me to get the new products in coming into the stores, there will not be any size constraint. We don't see that as a problem.
Got it. But we remain confident that 4 to 5% volume growth should be there, and then probably another 5-6%.
We should be able to achieve that because the market is growing at a very fast speed, and 4 to 5% volume growth as a company, we should at least target that for our older stores.
Okay, got it. The second question is on the rent to revenue ratio. If I look at it, say in top 8 cities versus tier 2 and tier 3 stores, broadly, how different they would be?
See, the rent to revenue ratio would be similar between a tier 1 and a tier 3, but the absolute rent will be lower. See, what happens in a tier 3 is the revenues also are lower, the rents also lower, and the other OPEX also in a store is lower. So from a percentages perspective, tier 3 and tier 1 are similar. We don't see too much of disparity in the rent to revenue ratio. See, there are some cities where rent to revenue is generally high, like for example, a city like Delhi. Delhi, in general, rent to revenue ratio is a lot higher, but Delhi is just one city as an exception. Otherwise, more or less between tier 1 and tier 3, it is very similar as if we're looking at it as a percentage.
Okay. Okay. Just one clarity on the LFS side. Are we selling on a consignment basis or is it a SOR basis?
It's a SOR, a principal to principal basis.
Okay. So it means that if the inventory doesn't sell, the LFS can return back the goods to the company. Is that correct?
Absolutely. Yes, absolutely.
Got it. Got it. Thanks a lot. That's it from my side, and best wishes for coming quarters.
Thank you. Thank you so much.
Thank you. Our next question is from the line of Vinayak Mohta from Stallion Asset. Please go ahead.
Yeah, hi. Congratulations on a good set of numbers. I just had two questions. So basically, given you mentioned that your quarter 3 is your best quarter, followed by quarter 1, quarter 2, and quarter 4, could you in any way give a sense of what percentage of revenue comes from these quarters on a general average level historically?
See, broadly, we have seen 33% of our business comes from quarter 3, and 25-27% of the business comes from quarter 1. It's just broad numbers from my old experience. See, actually, what has happened is post-COVID, some months pre-COVID used to be average. Now post-COVID has changed. I mean, the trends of seasonalities have a little bit changed post-COVID. But on a broad basis, Q3 contributes to about 33% of the business.
Understood. And just was trying to understand, like volume growth is something you mentioned that would be 4 to 5% on the SSG level, and then you'll have some growth coming from the new stores. I wanted to understand how further can you see, the ASPs increasing, because given you're bringing in 80% of your products on the lower than 1,000 category. So on an average, do you think that 700, your current ASP of broadly 718 to 750 would be the upper threshold for the ASPs, or do you think that eventually this can increase?
No, there will be
what is the factor?
I agree. I understand what you're saying. So there will be still room for growth. So the ASPs eventually will grow up between 800 and 900, eventually, slowly.
And this would be led by more of higher product mix towards the higher end categories, major.
Exactly, other categories, absolutely. But our strategy is very clear that we want to price our products below 1,000. 80% of our products are below 1,000.
Understood. And broadly, what kind of growth rate expectations is the management carrying for the next, 2 to 3 years at least, or if you have a longer term vision, something that you're looking at?
So we should, at least the company expects to grow at a CAGR of more than 20% in the short term future.
Understood. Okay, great. Thank you. Thank you so much. All the best.
Thank you. Thank you.
Thank you. Our next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Thanks for the opportunity and congrats on a very good execution. A couple of questions from my side. You spoke about store achieving mature state in span of 12 to 18 months. Just wanted to understand what parameters, financial ones, you use to qualify a store as a mature one. Is it largely a time period, or you use financial parameters as
well? Largely time period. I mean, look, there have been some cases where the store has also matured only by the 36th month. Like, for example, we opened a store in a tier 3 city in North. The first 2 years were very average, but slowly it started picking up. Now the store is doing very well. So sometimes the store does pick up after 3 years. But in most cases, we have seen from a time period perspective, between 18 to 24 months, the store should reach some sort of reasonable revenue.
Okay. But
so it's more from a time parameter perspective.
But then if I have to identify it has to...
Your voice is breaking, Tejas. Request you to come in a network area, please.
Yeah. This better. Hello.
Yes, go ahead.
Yeah. So if let's say you have to identify an overachieving store or an underperforming store, that time period has to reflect into some sort of financial parameters. It could be volume throughput or value throughput. So just wanted to understand, out of the two, volume and value, which parameter and what is that number that you...
We see a value parameter at least if a store is able to reach 60 lakhs a year revenue, then we know that it has reached some sort of maturity. 60 lakhs a year revenue benchmark.
Okay. And this usually happens within 18 to 24.
I mean, it ranges, but it broadly happens between 18 and 20.
Okay. And then second, interesting comment you made that even in mature store, we target 4%.
Again, I'm sorry to interrupt you.
I'll again. No problem. Thanks.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing remarks. Over to you, sir.
Thank you everyone for joining us. I hope you've been able to answer. We have been able to answer all your queries. We look forward to such interactions in the future. We hope to live up to the expectations of you all in the future. In case you require any further details, you may contact Mr. Deven Dhruva from SGA, our investor relations partner. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Go Fashion India Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.